Question 1. Regulatory review indicates that a real estate agent operating in the Australian Capital Territory Act is advising a client on the sale of their property. The current economic climate is characterized by rising inflation and increasing interest rates, which are beginning to impact the ACT's property market. What is the most responsible and ethically sound approach for the agent to take in advising their client regarding the potential impact of these economic factors on their sale? Option A. Emphasize only the positive aspects of the current market to encourage a swift sale, while minimizing discussion of any potential negative economic influences. Option B. Conduct a comprehensive analysis of current and projected economic conditions affecting the ACT property market, transparently communicating both potential opportunities and risks to the client, and guiding them in making decisions aligned with their financial goals. Option C. Withhold information about rising interest rates and inflation, assuming the client is already aware and focusing solely on marketing the property's features. Option D. Offer personal opinions and anecdotal evidence about future market trends without referencing specific economic data or the ACT's market context. Correct answer is B. Conduct a comprehensive analysis of current and projected economic conditions affecting the ACT property market, transparently communicating both potential opportunities and risks to the client, and guiding them in making decisions aligned with their financial goals. Explanation. This scenario presents a professional challenge for a real estate agent in the Australian Capital Territory Act, due to the inherent volatility of real estate markets and the influence of broader economic factors. The agent must navigate potential conflicts of interest and ensure they are providing advice that is both legally compliant and ethically sound, prioritizing the client's best interests above all else. The ACT's regulatory framework, particularly the Agents Act 2003 Act, and its associated regulations, mandates a high standard of conduct and disclosure. The best professional approach involves a thorough and objective assessment of current and projected market conditions, supported by credible data and analysis, and transparently communicating these findings to the client. This includes discussing how macroeconomic trends, such as interest rate changes, inflation, and employment figures, are likely to impact property values and demand within the ACT. The agent should then guide the client in making informed decisions based on this objective information, ensuring all advice aligns with the client's specific financial goals and risk tolerance. This approach is correct because it directly upholds the agent's fiduciary duty to the client, as reinforced by the Agents Act 2003 Act, which requires agents to act honestly, efficiently, and in the best interests of their clients. It also aligns with the ethical principles of transparency and informed consent, an approach that focuses solely on promoting the property by highlighting only positive market indicators, while downplaying or omitting any potential negative economic influences, is professionally unacceptable. This failure to provide a balanced and comprehensive market analysis constitutes a breach of the agent's duty of care and potentially misleading conduct under the Agents Act 2003 Act. It prioritizes securing a sale over the client's informed decision-making. Another professionally unacceptable approach is to provide speculative advice based on personal opinions or unsubstantiated rumors about future market movements, without grounding it in objective economic data relevant to the ACT. This lacks the rigor required by professional standards and could lead to significant financial detriment for the client, violating the agent's obligation to act with due skill and diligence. Finally, an approach that involves withholding information about adverse economic trends or regulatory changes that could impact property values, with the intention of expediting a transaction, is a serious ethical and regulatory failing. This constitutes deceptive or misleading conduct and directly contravenes the spirit and letter of the Agents Act 2003 Act, which demands full disclosure and honesty in all dealings. Professionals should adopt a decision-making process that prioritizes client welfare, grounded in a comprehensive understanding of the relevant regulatory framework, Agents Act 2003 Act, and associated regulations, market dynamics, and economic principles. This involves continuous professional development, diligent research, transparent communication, and a commitment to ethical conduct, ensuring that advice is objective, accurate, and tailored to the client's individual circumstances. Question 2. Consider a scenario where a property investor in the Australian Capital Territory Act is seeking to quickly acquire a commercial property but has limited access to traditional bank financing. They are exploring the use of hard money loans and seller financing. As their real estate agent, what is the most responsible and ethically sound approach to advising them on these financing options? Option A. Focus on the simplicity of seller financing, suggesting it as a straightforward way to avoid bank bureaucracy and help draft a basic agreement between the buyer and seller. Option B. Recommend the financing option that appears most likely to result in the quickest sale, without dwelling on the specific details or risks of each, to expedite the transaction. Option C. Emphasize the speed and accessibility of hard money loans, highlighting their potential to close deals quickly, and assist the investor in preparing the necessary documentation for such a loan. Option D. Thoroughly explain the characteristics, risks, and typical terms of both hard money loans and seller financing, and strongly advise the investor to seek independent legal and financial advice before making any decisions. The correct answer is D. Thoroughly explain the characteristics, risks, and typical terms of both hard money loans and seller financing, and strongly advise the investor to seek independent legal and financial advice before making any decisions. Explanation. This scenario presents a professional challenge for a real estate agent in the Australian Capital Territory, ACT, due to the inherent risks and disclosure obligations associated with unconventional financing methods like hard money loans and seller financing. Navigating these options requires a deep understanding of the ACT's property laws, consumer protection regulations, and ethical duties to clients. The agent must balance facilitating a deal with ensuring the client fully comprehends the implications and potential pitfalls of each financing strategy. The best professional approach involves thoroughly educating the client about the nature, risks, and typical terms of both hard money loans and seller financing, and then recommending they seek independent legal and financial advice specific to their situation before committing. This approach prioritizes informed consent and client protection, aligning with the ACT's regulatory framework that mandates agents act honestly, fairly, and with due skill and diligence. Specifically, the Agents Act 2003 Act and its associated regulations require agents to disclose all material facts and avoid misrepresentation. By strongly advising independent professional consultation, the agent fulfills their duty to ensure the client makes a decision based on comprehensive understanding, mitigating potential future disputes or financial harm. An approach that focuses solely on the speed and ease of securing a hard money loan without adequately explaining its high interest rates, short repayment terms, and potential for foreclosure is professionally unacceptable. This fails to meet the duty of care and skill, potentially leading the client into a detrimental financial commitment without full awareness. Similarly, presenting seller financing as a simple alternative without detailing the seller's ongoing interest in the property, the potential for complex contractual arrangements, and the importance of independent legal review of the agreement would be a significant ethical and regulatory failing. This oversight could breach the agent's obligation to disclose all relevant information and act in the client's best interests. Professionals should adopt a decision-making process that begins with identifying the client's primary objectives and risk tolerance. They must then clearly explain all available financing options, including their advantages and disadvantages, with a particular emphasis on the specific risks associated with non-traditional methods like hard money and seller financing within the ACT context. Crucially, this education must be followed by a strong recommendation for the client to obtain independent legal and financial advice before proceeding. This ensures the client is empowered to make an informed decision, thereby protecting both the client and the agent from potential liabilities. Question 3. Upon reviewing recent market performance in the Australian Capital Territory ACT, a property manager is advising a client on whether to sell an investment property. Considering the ACT's unique economic drivers and regulatory landscape, which of the following approaches best reflects professional and ethical practice in navigating real estate cycles? Option A. Focus on securing a quick sale by highlighting only the most optimistic future market scenarios for the ACT, regardless of underlying data or potential risks. Option B. Conduct a detailed analysis of historical ACT property market data, current economic indicators specific to the ACT, and projected future trends, presenting a balanced view of potential market cycles and their implications for the client's investment. Option C. Advise the client to sell immediately, emphasizing the recent rapid price increases as a guaranteed indicator of continued exponential growth in the ACT market. Option D. Base the selling recommendation on the strong performance of similar properties in Sydney or Melbourne, assuming the ACT market will follow similar patterns. The correct answer is B. Conduct a detailed analysis of historical ACT property market data, current economic indicators specific to the ACT, and projected future trends, presenting a balanced view of potential market cycles and their implications for the client's investment. Explanation: this scenario presents a professional challenge due to the inherent volatility and cyclical nature of the Australian Capital Territory Act real estate market. A property manager must navigate these cycles to provide sound advice and manage client expectations effectively, balancing the desire for immediate profit with long-term investment stability. The ACT's specific planning regulations and market dynamics, influenced by government policy and population growth, require a nuanced understanding beyond general market trends. Careful judgment is required to avoid misrepresenting market conditions or recommending strategies that could lead to financial detriment for clients. The best approach involves a comprehensive analysis of historical ACT property market data, current economic indicators specific to the ACT, and projected future trends, considering factors like interest rates, employment, and government infrastructure projects. This approach prioritizes providing clients with data-driven insights into the ACT's real estate cycles, enabling informed decision-making about buying, selling, or holding property. This aligns with the ethical obligations of real estate professionals in the ACT to act with honesty, integrity, and due skill, care, and diligence, as outlined in the ACT's Property Occupations Act 2002 and associated regulations. It ensures advice is grounded in the specific realities of the ACT market, not speculative assumptions. An approach that focuses solely on recent rapid price increases, without acknowledging potential market corrections or downturns, is professionally unacceptable. This failure to provide a balanced perspective can lead clients to make decisions based on an incomplete understanding of the ACT's real estate cycles, potentially exposing them to significant financial risk if the market shifts, breaches the duty to provide accurate and realistic advice. Another unacceptable approach is to base recommendations on anecdotal evidence or the performance of properties in different Australian states or territories. The ACT market has unique drivers and characteristics that may not be mirrored elsewhere. Relying on such information disregards the specific regulatory environment and market dynamics of the ACT, failing to meet the professional standard of care. Finally, an approach that prioritizes securing a quick sale or lease agreement above all else, even if it means downplaying potential market risks or overstating future growth in the ACT, is unethical. This demonstrates a conflict of interest, where the professional's gain is prioritized over the client's best interests, and it violates the principle of providing objective and unbiased advice. Professionals should employ a decision-making framework that begins with understanding the client's objectives and risk tolerance. This should be followed by a thorough, data-driven analysis of the ACT real estate market, incorporating both historical trends and forward-looking projections. The professional must then communicate these findings clearly and transparently to the client, outlining potential opportunities and risks associated with different market phases within the ACT. This ensures that advice is tailored, ethical, and compliant with ACT legislation. Question 4. When evaluating a proposed development by a strata title owner in the Australian Capital Territory Act that appears to extend onto what might be common property, what is the most responsible and legally compliant course of action for a real estate agent representing the developer? Option A. Advise the developer to commence construction immediately to secure the opportunity, and then seek retrospective approval or negotiate with the owner's corporation if any objections are raised. Option B. Conduct a thorough review of the registered strata plan bylaws and any management statements to precisely determine the boundaries of the individual lot and common property, and advise the developer on the legal requirements for any proposed alterations or additions, including potential consent from the owner's corporation or plan amendments. Option C. Proceed with the development based on the developer's assurances that the proposed area is within their lot, and address any potential issues with lot owners or the owner's corporation only if they arise during or after construction. Option D. Assume that any development on the periphery of the property is permissible as long as it does not directly obstruct existing access points for other lot owners, and proceed without formal verification of property boundaries. Correct answer is B. Conduct a thorough review of the registered strata plan bylaws and any management statements to precisely determine the boundaries of the individual lot and common property, and advise the developer on the legal requirements for any proposed alterations or additions, including potential consent from the owner's corporation or plan amendments. Explanation: this scenario is professionally challenging because it involves a potential conflict between a developer's desire to maximize profit and the legal framework governing property rights and ownership in the Australian Capital Territory Act. The agent must navigate the complexities of strata title management and the rights of individual lot owners to ensure compliance with the Unit Titles Act 2001 Act and associated regulations. Careful judgment is required to balance commercial interests with legal obligations and ethical duties. The best professional approach involves diligently investigating the existing strata plan and associated documents, including any registered bylaws or management statements, to understand the precise boundaries of the common property and individual units. This includes verifying whether the proposed development encroaches upon common property or infringes upon the exclusive use rights of existing lot owners. The agent should then advise the developer on the legal requirements for any proposed alterations or additions, which may necessitate obtaining consent from the owner's corporation or even amending the strata plan, as dictated by the Unit Titles Act 2001 Act. This approach is correct because it prioritizes adherence to the governing legislation, protects the property rights of all stakeholders, and ensures the development proceeds lawfully. It upholds the agent's duty of care and professional integrity by providing accurate, legally sound advice. An incorrect approach would be to proceed with the development based solely on the developer's assurances or a cursory review of the strata plan, without undertaking a thorough legal and physical verification of property boundaries and common property. This fails to comply with the Unit Titles Act 2001 Act, which clearly defines the rights and responsibilities associated with strata title ownership and common property. Such an approach risks significant legal challenges, financial penalties, and reputational damage for both the agent and the developer, as it disregards the established property rights of existing lot owners. Another incorrect approach would be to assume that any proposed development on the periphery of the property automatically falls within the developer's individual lot, without confirming this through official documentation and potentially a survey. The Unit Titles Act 2001 Act distinguishes clearly between individual lots and common property, and any encroachment onto common property without proper authorization is a breach of the Act. This approach ignores the fundamental principles of strata title ownership and the collective rights of the owner's corporation. A further incorrect approach would be to advise the developer to proceed with the development and address any potential issues with lot owners or the owner's corporation only after construction has commenced or been completed. This is ethically unsound and legally risky. The Unit Titles Act 2001 Act requires adherence to established procedures for alterations and developments, and attempting to rectify breaches retrospectively is often more complex, costly, and may not be permissible. It undermines the rights of lot owners to be consulted and to have their property interests protected from the outset. Professionals should adopt a decision-making framework that begins with a comprehensive understanding of the relevant legislation, in this case, the Unit Titles Act 2001 Act. This involves identifying all stakeholders and their respective rights and obligations. The next step is to gather all relevant documentation and conduct thorough due diligence, including verifying property boundaries and identifying common property. Any proposed actions must be assessed against the legal requirements, and advice should be provided that prioritizes compliance and the protection of all parties' interests. If there is any ambiguity or potential for conflict, seeking legal advice specific to ACT strata law is paramount. Question 5. The analysis reveals that a real estate agent in the Australian Capital Territory Act is facilitating the sale of a residential property. During the final stages of negotiation, the vendor expresses a desire to include a clause in the contract allowing them to retain a specific antique fixture from the property, which was not explicitly mentioned in the initial marketing materials. The agent, aware that this fixture is highly desirable to the prospective buyer and could potentially jeopardize the sale if revealed too late, is considering how to best manage this request to ensure the contract's enforceability and maintain client satisfaction. Which of the following approaches best upholds the agent's professional and legal obligations in the ACT? Option A. Inform the vendor that the fixture is a minor detail and can be resolved informally after the contract is signed, without needing to amend the formal contract. Option B. Advise the vendor that the fixture is likely considered part of the property and cannot be removed without potentially voiding the contract, suggesting they abandon the request to ensure a smooth sale. Option C. Immediately advise the vendor that such a clause must be clearly communicated to the buyer and formally incorporated into the contract of sale, recommending they seek legal advice to ensure its enforceability and to avoid any misrepresentation claims. Option D. Proceed to draft an amendment to the contract including the clause, assuming the buyer will not notice or object to it given the overall favorable sale price. The correct answer is C. Immediately advise the vendor that such a clause must be clearly communicated to the buyer and formally incorporated into the contract of sale, recommending they seek legal advice to ensure its enforceability and to avoid any misrepresentation claims. Explanation. The analysis reveals a scenario that is professionally challenging due to the inherent conflict between a real estate agent's duty to their client and the potential for personal gain. The agent must navigate the complexities of contract law in the Australian Capital Territory Act, while upholding ethical obligations of honesty and transparency. The enforceability of a contract hinges on several key elements, including offer, acceptance, consideration, intention to create legal relations, and capacity. In the ACT, the Sale of Residential Property Act 1973 and related common law principles govern these aspects. Best professional approach involves a commitment to full disclosure and adherence to contractual formalities. This means ensuring all parties understand the terms, that any amendments are properly documented and agreed upon, and that the agent acts solely in the best interests of their client, avoiding any situation that could be perceived as a conflict of interest. This aligns with the ethical duties of an agent under ACT real estate legislation and common law, which mandate acting with integrity and avoiding misleading or deceptive conduct. An incorrect approach would be to proceed with a contract amendment without full client consent or to downplay the significance of a contractual term. This could lead to a contract being deemed unenforceable or voidable and would constitute a breach of the agent's fiduciary duties and statutory obligations in the ACT. Failing to disclose material facts or misrepresenting the terms of an agreement are serious ethical and legal transgressions. Another unacceptable approach is to prioritize personal benefit over client interests, such as by subtly influencing a client towards a decision that benefits the agent, even if it is not the client's optimal choice. This violates the core principles of agency law and ethical conduct expected of real estate professionals in the ACT. Professional decision-making in such situations requires a clear understanding of ACT contract law and real estate regulations, a commitment to ethical principles, and a proactive approach to communication and documentation. Agents must always prioritize their clients' informed consent and best interests, ensuring all contractual dealings are transparent, fair, and legally sound. Question 6. Benchmark analysis indicates that mortgage brokers in the Australian Capital Territory Act often face commission structures that can influence product recommendations. Ms. Davies, a first home buyer, is seeking advice on a mortgage and has expressed concerns about managing her repayments over the long term. Considering the potential for commission bias, which approach best upholds Ms. Davies' best interests and complies with ACT lending regulations? Option A. Recommend an adjustable rate mortgage, highlighting its potentially lower initial repayments, as this product typically offers a higher commission to the broker, and assume Ms. Davies will be able to manage future interest rate increases. Option B. Advise Ms. Davies to take out an interest-only mortgage for the longest possible term to minimize her immediate repayment obligation, without thoroughly exploring her capacity to repay the principal at the end of the term. Option C. Present-only fixed-rate mortgages as the safest option, even if Ms. Davies has indicated a willingness to explore other products, to ensure a straightforward transaction that maximizes the broker's commission through a higher loan amount. Option D. Thoroughly assess Ms. Davies' financial situation and risk tolerance, clearly explain the features, benefits and risks of fixed rate, adjustable rate, and interest-only mortgages in the ACT context, and recommend the product that best aligns with her long-term affordability and stated objectives, irrespective of commission. Similarly, pushing an interest-only mortgage without a clear and documented plan for how the principal will be repaid at the end of the interest-only period, or if Ms. Davies lacks the capacity to manage such a repayment, violates the NCCP Act's requirements for assessing repayment capacity. Presenting a fixed-rate mortgage as the only option without exploring other potentially suitable products, even if it results in a lower commission, could also be problematic if it doesn't genuinely align with Ms. Davies' stated preferences or financial situation, though the primary ethical failure lies in recommending unsuitable products for higher commission. Professional reasoning. Professionals in the ACT mortgage broking industry must adopt a client-centric approach. This involves a structured process. First, comprehensively understanding the client's financial circumstances, goals, and risk appetite. Second, educating the client about all relevant mortgage products available in the ACT market, including their specific features, benefits, and risks. Third, providing a clear, unbiased recommendation that demonstrably aligns with the client's best interests, supported by a detailed explanation of why that recommendation is suitable. Finally, documenting the entire process, including the client's understanding and consent, to ensure compliance with regulatory obligations and ethical standards. Question 7. Implementation of a real estate sale in the Australian Capital Territory Act is being managed by an agent who is aware that the vendor's ability to proceed with the sale is contingent on them securing a specific loan to purchase their next property. The agent has not yet disclosed this financing contingency to a prospective buyer who has expressed strong interest. What is the most appropriate course of action for the agent to take? Option A. Present the sale as unconditional to the prospective buyer, focusing on securing their offer and dealing with the vendor's financing separately. Option B. Downplay the importance of the vendor's financing situation to the prospective buyer, suggesting it is a minor detail that will be resolved. Option C. Immediately inform the prospective buyer that the vendor's sale is conditional upon their own financing arrangements being finalized. Option D. Advise the prospective buyer to proceed with their own financing arrangements, assuring them that the vendor's situation is being handled. The correct answer is C. Immediately inform the prospective buyer that the vendor's sale is conditional upon their own financing arrangements being finalized. Explanation. Scenario analysis. This scenario presents a professional challenge for a real estate agent in the Australian Capital Territory Act, due to the inherent conflict of interest and the potential for misleading representations to a buyer. The agent's duty of care and fiduciary obligations to both the vendor and the prospective purchaser are paramount. Failing to disclose material facts about the financing arrangements, especially when they are contingent and potentially disadvantageous to the buyer, erodes trust and can lead to significant legal and ethical repercussions under ACT property law and professional conduct rules. The agent must navigate the delicate balance of facilitating a sale while upholding their ethical obligations to all parties involved. Correct approach analysis. The best professional approach involves transparently disclosing to the prospective buyer that the vendor's sale is contingent upon securing specific financing, and that this financing is not yet finalized. This approach aligns with the principles of honesty, fair dealing, and disclosure mandated by the ACT's property legislation and professional standards for real estate agents. By clearly communicating the conditional nature of the sale, the agent ensures the buyer is making an informed decision, thereby fulfilling their duty to act in the best interests of all parties to the extent possible within their agency agreement. This proactive disclosure prevents potential misunderstandings and future disputes. Incorrect approaches analysis. Presenting the sale as unconditional and implying the vendor has secured all necessary funds, without mentioning the financing contingency, constitutes a misleading representation. This breaches the agent's duty of honesty and fair dealing, potentially violating provisions of the ACT Civil and Administrative Tribunal Act 2008 and the Agents Act 2003, which govern professional conduct and require agents to avoid misrepresentation. Suggesting the buyer should proceed with their own financing arrangements without informing them of the vendor's specific and potentially problematic financing situation is also professionally unsound. Buyers typically arrange their own finance. The agent has a duty to disclose material facts about the transaction that could impact the buyer's decision-making. Failing to do so, especially when the vendor's financing is a critical element of the sale's viability, is a dereliction of duty. Focusing solely on securing the sale by downplaying or omitting the vendor's financing challenges and assuring the buyer that everything is in order without verification demonstrates a lack of diligence and prioritizes commission over ethical conduct. This can lead to a breach of contract and professional misconduct, as agents are expected to act with integrity and competence. Professional reasoning. Professionals in ACT real estate should adopt a decision-making framework that prioritizes transparency and informed consent. When faced with a situation involving contingent financing, the agent must first identify the material fact, the vendor's financing contingency. Next, they must consider their legal and ethical obligations, which include disclosure and avoiding misleading conduct. The agent should then communicate this material fact clearly and promptly to the prospective buyer, explaining its implications for the transaction. This ensures the buyer can make an informed decision based on complete information, thereby upholding professional standards and mitigating risks for all parties. Question 8. To address the challenge of developing a new residential estate in the Australian Capital Territory Act that may impact a nearby sensitive wetland ecosystem, what is the most responsible and legally compliant course of action for the developer? Option A. Conduct a comprehensive environmental impact assessment, IA, to identify potential risks to the wetland. Consult with the ACT Environment Protection Authority, EPA, for guidance on mitigation strategies, and integrate these findings into the development plans before submitting the application. Option B. Submit the development application with minimal detail regarding the wetland's proximity and potential impacts, focusing primarily on the economic benefits of the project. Option C. Proceed with the development application based on a preliminary assessment, assuming any minor environmental concerns can be addressed through standard landscaping and drainage solutions after approval. Option D. Rely exclusively on the developer's internal environmental team to manage all environmental considerations, without seeking external expert advice or engaging with the ACT EPA during the planning phase. The correct answer is A. Conduct a comprehensive environmental impact assessment, IA, to identify potential risks to the wetland. Consult with the ACT Environment Protection Authority, EPA, for guidance on mitigation strategies, and integrate these findings into the development plans before submitting the application. Explanation. This scenario is professionally challenging because it requires balancing the financial interests of a developer with the environmental protection obligations mandated by the Australian Capital Territory Act government. Navigating the complex interplay between development aspirations and environmental stewardship demands careful judgment and adherence to specific legislative frameworks. The best approach involves proactively engaging with the ACT Environment Protection Authority, EPA, and relevant planning authorities early in the development process. This includes conducting thorough environmental impact assessments, IA, that identify potential risks to local ecosystems, water quality, and biodiversity. By seeking pre-application advice and incorporating mitigation strategies identified through the EIA into the development plans, the developer demonstrates a commitment to compliance and responsible land use. This proactive engagement ensures that the development proposal aligns with the objectives of the ACT's environmental legislation, such as the Planning and Development Act 2007 and the Environment Protection Act 1997, which prioritize sustainable development and the protection of the environment. An incorrect approach would be to proceed with the development without adequately assessing potential environmental impacts, assuming that minor issues can be addressed post-approval. This disregards the legislative requirement for comprehensive EIAs and the EPA's mandate to prevent or minimize environmental harm. Such an approach risks significant delays, substantial fines, and potentially the refusal of development applications due to non-compliance with environmental standards. Another unacceptable approach is to minimize or omit information regarding potential environmental risks in the development application. This constitutes a misrepresentation of facts and undermines the integrity of the planning and assessment process. It violates ethical obligations to be transparent with regulatory bodies and fails to uphold the principles of environmental accountability enshrined in ACT law. A further flawed strategy would be to rely solely on the advice of a planning consultant, without independently verifying that the proposed environmental mitigation measures meet the stringent requirements of ACT environmental legislation. While consultants are valuable, the ultimate responsibility for compliance rests with the developer. Failing to ensure that the proposed measures are robust and legally sound can lead to unforeseen environmental damage and regulatory penalties. Professionals should adopt a decision-making framework that prioritizes understanding and adherence to the specific environmental regulatory landscape of the ACT. This involves 1. Thoroughly researching and understanding the relevant legislation, e.g., Planning and Development Act 2007, Environment Protection Act 1997, and associated regulations. 2. Engaging early and transparently with regulatory bodies like the ACT EPA. 3. Commissioning comprehensive and accurate environmental impact assessments. 4. Integrating identified mitigation measures into the development proposal from the outset. 5. Seeking expert advice but retaining ultimate responsibility for due diligence and compliance. Question 9. Examination of the data shows that a mortgage applicant in the Australian Capital Territory Act is eager for a swift loan approval to secure a property purchase before a competitor makes an offer. The applicant has provided initial documentation and verbally confirmed their employment and income details. What is the most appropriate course of action for the loan underwriter? Option A. Conduct a comprehensive review of all submitted documentation. Verify income and employment stability, assess credit history, and obtain a professional property valuation, adhering strictly to the lender's policies and ACT lending regulations before granting approval. Option B. Proceed with a partial review of the submitted documents, approving the loan with a caveat that full verification will be completed post-settlement to meet the applicant's urgent timeline. Option C. Approve the loan based on the applicant's strong existing relationship with the bank and their reputation, assuming they are a reliable borrower, and complete a full documentation review at a later stage. Option D. Expedite the approval process by relying on the applicant's verbal confirmations and a preliminary credit check, deferring detailed document verification and property valuation until after the loan is conditionally approved. The correct answer is A. Conduct a comprehensive review of all submitted documentation, verify income and employment stability, assess credit history, and obtain a professional property valuation, adhering strictly to the lender's policies and ACT lending regulations before granting approval. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the loan underwriter to balance the applicant's desire for a quick approval with the stringent regulatory obligations and ethical duties owed to both the applicant and the lender. The pressure to expedite the process, especially in a competitive market like the Australian Capital Territory Act, real estate sector, can lead to shortcuts that compromise due diligence. Failure to adhere to the prescribed loan underwriting and approval process can result in significant financial and reputational damage for the lender and potentially legal repercussions for the underwriter. Correct approach analysis. The best professional practice involves a thorough review of all submitted documentation, including verification of income, employment stability, credit history, and the property's valuation, in accordance with the Australian Capital Territories Act, specific lending guidelines, and the lender's internal policies. This approach ensures that the loan is approved based on a comprehensive assessment of the borrower's capacity to repay and the security offered, thereby mitigating risk and complying with regulatory requirements such as those overseen by the Australian Securities and Investments Commission, ASIC, for financial services providers. This meticulous process upholds the principle of responsible lending, a cornerstone of Australian financial regulation. Incorrect approaches analysis. One incorrect approach involves approving the loan based solely on the applicant's verbal assurances and a preliminary credit check, without verifying the supporting documentation or conducting a full property valuation. This bypasses critical due diligence steps mandated by responsible lending obligations and lender policies, increasing the risk of default and contravening regulatory expectations for robust risk assessment. Another unacceptable approach is to approve the loan based on a partial review of documents, with the intention of completing the full verification post-approval. This is a direct violation of the underwriting process, as the approval decision must be made on complete and verified information. It exposes the lender to significant unassessed risk and fails to meet the standards of care expected under ACT financial regulations. A further incorrect approach is to approve the loan by relying heavily on the applicant's existing relationship with the bank and their perceived trustworthiness, rather than on objective financial data and risk assessment. While a good relationship is beneficial, it cannot substitute for the rigorous, evidence-based assessment required by lending regulations and ethical practice to ensure the loan is suitable and repayable. Professional reasoning. Professionals should adopt a systematic and evidence-based approach to loan underwriting. This involves establishing clear internal policies and procedures that align with ACT and Australian federal regulations. A decision-making framework should prioritize risk assessment, compliance, and the applicant's genuine ability to service the debt. Regular training on regulatory updates and ethical conduct is crucial. In situations of pressure, professionals must refer to their established procedures and seek guidance from supervisors or compliance departments to ensure decisions are sound and defensible. Question 10. Research into potential investment opportunities in the Australian Capital Territory Act has identified 4 distinct property types: a suburban residential dwelling, a city centre retail complex, a light industrial warehouse on the outskirts of Canberra, and a rural grazing property. An investor wishes to understand the potential return on investment based on projected net annual rental income. If the projected net annual rental income for the residential dwelling is $30,000, for the retail complex is $150,000, for the industrial warehouse is $80,000, and for the grazing property is $20,000, and the current market-derived capitalization rates for these respective property types in the ACT are 5%, 7%, 6%, and 4%. What is the estimated market value for each property type based on its income-generating potential? Option A. Residential, $600,000, commercial, $1,050,000, industrial, $480,000, agricultural, $800,000. Option B. Residential, $750,000, commercial, $142,857, industrial, $1,333,333, agricultural, $500,000. Option C. Residential, $600,000, commercial, $142,857, industrial, $1,333,333, agricultural, $500,000. Option D. Residential, $600,000, commercial, $142,857, industrial, $1,333,333, agricultural, $400,000. The correct answer is C. Residential, $600,000, commercial, $142,857, industrial, $1,333,333, agricultural, $500,000. Explanation. This scenario presents a professional challenge due to the need to accurately assess and value different types of real estate within the Australian Capital Territory Act for a specific investment purpose. Professionals must navigate the distinct characteristics and valuation methodologies applicable to residential, commercial, industrial, and agricultural properties, ensuring compliance with ACT property law and relevant valuation standards. The challenge lies in applying appropriate financial metrics and understanding how market factors, zoning, and intended use influence each property type's potential return on investment. The best approach involves calculating the potential annual net rental income for each property type, and then applying a market-derived capitalization rate specific to that property class in the ACT. For residential properties, this would involve estimating achievable rents and vacancy rates, then deducting operating expenses. For commercial properties, factors like lease terms, tenant covenants, and market rental growth are crucial. Industrial properties require consideration of specialized uses and potential for obsolescence. Agricultural land valuation would focus on its productive capacity and potential for subdivision or development. Capitalization rate, derived from recent comparable sales of similar property types in the ACT, reflects the risk and return expectations for each asset class. The formula for this is net operating income / capitalization rate equals property value. This method directly addresses the investor's objective of understanding potential income generation and is grounded in established valuation principles recognized within the ACT property market. An incorrect approach would be to apply a single, generic capitalization rate across all property types. This fails to acknowledge the inherent differences in risk, management intensity, and market dynamics between residential, commercial, industrial, and agricultural sectors in the ACT. For instance, applying a residential cap rate to a large industrial complex would misrepresent its true market value and investment potential. Another incorrect approach would be to solely focus on the initial purchase price, without considering the potential for income generation or future capital appreciation specific to each property type's market. This overlooks the fundamental principle of investment valuation, which is based on the present value of future economic benefits. A further incorrect approach would be to use a valuation method that is not standard for the specific property type in the ACT, such as using a cost approach for a fully tenanted commercial building, where an income approach is more appropriate. This would lead to an inaccurate valuation that does not reflect market realities or investor expectations. Professionals should employ a systematic decision-making process that begins with clearly defining the investment objective. This is followed by identifying the relevant property types and gathering specific market data for the ACT. The next step is to select the most appropriate valuation methodology for each property type, considering factors like intended use, income-generating potential, and market comparables. Finally, calculations should be performed meticulously, and the results reviewed for reasonableness within the context of the ACT property market. Question 11. Which approach would be most appropriate for a valuer to adopt when determining the market value of a unique, income-generating commercial office building in the Australian Capital Territory, where direct sales comparables are scarce and the property's primary value is derived from its rental income potential? Option A, comparative market analysis. Option B, income approach. Option C, a combination of all three approaches without specific emphasis on income generation. Option D, cost approach. The correct answer is B, income approach. Explanation. This scenario presents a professional challenge for a valuer in the Australian Capital Territory, ACT, due to the need to provide a robust and defensible valuation for a unique commercial property with limited direct comparables. The valuer must select the most appropriate methodology that aligns with professional standards and ACT property law, ensuring the valuation accurately reflects the property's market value while considering its specific characteristics. The most appropriate approach in this scenario is the income approach. This method is best suited for income-generating properties, such as a commercial office building, where the primary driver of value is the potential to generate future rental income. By analyzing the net operating income and applying an appropriate capitalization rate, the valuer can derive a market value that reflects investor expectations and the property's earning capacity. This aligns with the principles of the Valuers Registration Act 2001 Act and the Australian Property Institute, API, professional practice standards, which mandate the use of valuation methods that best reflect the property's market. The income approach is particularly relevant when direct sales comparables are scarce or not truly representative of the subject property's unique attributes and income potential. The comparative market analysis approach, while a fundamental valuation tool, will be less reliable in this specific ACT context. Its effectiveness is heavily dependent on the availability of recent, similar sales of comparable properties. Given the unique nature of the commercial office building and the potential scarcity of truly comparable recent sales in the ACT market, relying solely on this method could lead to an inaccurate or poorly supported valuation. This could contravene the valuer's duty to provide an accurate and well-supported opinion of value under the Valuers Registration Act 2001 Act. The cost approach, which estimates the cost to replace or reproduce the property, is generally less suitable for older, income-producing commercial properties. While it can provide a ceiling on value, it often fails to capture the market's perception of value based on income generation, which is a critical factor for commercial real estate in the ACT. Furthermore, accurately estimating depreciation for an older building can be subjective and challenging, potentially leading to a valuation that does not reflect the true market value as perceived by potential investors. This could be seen as a failure to adhere to the principle of market value as defined by professional standards. Professionals in the ACT should adopt a systematic decision-making process when selecting a valuation approach. This involves 1. Understanding the property type and its primary value drivers. 2. Assessing the availability and reliability of data for each valuation method. 3. Considering the specific market conditions in the ACT. And 4. Applying professional judgment in accordance with the Valuers Registration Act 2001 Act and API standards. In cases of unique properties or limited comparables, the income approach often provides the most robust and defensible valuation. Question 12. The control framework reveals that a property development company operating in the Australian Capital Territory Act is preparing its financial strategy for the upcoming year. The investor group is seeking detailed assurance on financial projections and risk management, while the operational management team is focused on immediate project execution and resource allocation. Which approach best balances stakeholder expectations and regulatory compliance in the budgeting and reporting process? Option A. Present a budget that prioritizes immediate operational needs over long-term financial sustainability, without thorough internal review or risk assessment. Option B. Develop a comprehensive, internally reviewed budget detailing projected income, expenses, capital expenditures, and contingencies, accompanied by a report explaining assumptions, risks, and strategic alignment, and present this proactively to the investor group. Option C. Delay the budget presentation to the investor group until after the operational management team has finalized all internal spending plans, without any interim communication. Option D. Present a high-level summary budget to the investor group without detailed supporting documentation or explanations of underlying assumptions. The correct answer is B. Develop a comprehensive, internally reviewed budget detailing projected income, expenses, capital expenditures, and contingencies, accompanied by a report explaining assumptions, risks, and strategic alignment, and present this proactively to the investor group. Explanation. The control framework reveals a critical juncture in financial management for a property development company operating in the Australian Capital Territory Act. The scenario is professionally challenging because it requires balancing the immediate needs of stakeholders with the long-term financial health and regulatory compliance of the company. The differing expectations of the investor group and the operational management team create a tension that necessitates careful judgment, particularly concerning the timing and detail of financial reporting. Adherence to the ACT's specific regulatory environment for property development and financial reporting is paramount. The best professional approach involves preparing a comprehensive, internally reviewed budget for the upcoming financial year that clearly outlines projected income, expenses, capital expenditures, and contingency funds. This budget should then be presented to the investor group, accompanied by a detailed report explaining the assumptions underpinning the budget, potential risks and mitigation strategies, and how the budget aligns with the company's strategic objectives and ACT property market conditions. This approach is correct because it prioritizes transparency and proactive communication with key stakeholders, fulfilling the requirements of good corporate governance and financial stewardship. Specifically, under ACT legislation and general principles of financial management for companies, timely and accurate financial reporting to investors is a fundamental obligation. This proactive disclosure builds trust, allows investors to make informed decisions, and demonstrates responsible management of their capital. It also ensures that the company is operating within a clearly defined financial plan that has been vetted internally. An approach that involves presenting a high-level summary budget to the investor group without detailed supporting documentation or explanations of assumptions is professionally unacceptable. This fails to provide investors with the necessary information to understand the financial projections and risks, potentially leading to misinformed decisions and a breach of trust. It also neglects the need for robust internal financial scrutiny before external presentation. Another professionally unacceptable approach is to delay the budget presentation to the investor group until after the operational management team has finalized all internal spending plans, without any interim communication. This creates an information vacuum for investors, making them feel excluded and undermining their confidence in the management's transparency and responsiveness. It also risks the company operating without clear investor alignment on financial strategy for a period. Finally, an approach that involves presenting a budget that has not undergone thorough internal review or risk assessment, and which prioritizes immediate operational needs over long-term financial sustainability, is also professionally unsound. This demonstrates a lack of due diligence and foresight, potentially exposing the company and its investors to significant financial risks. It fails to meet the ethical obligation to manage investments prudently and in accordance with sound financial principles, which are implicitly expected under ACT corporate and financial regulations. Professionals should employ a decision-making framework that begins with identifying all relevant stakeholders and their interests. This is followed by a thorough understanding of the applicable regulatory requirements, in this case, ACT financial reporting and property development laws. The next step involves developing options that address stakeholder needs while adhering to regulations. Each option should then be evaluated against criteria such as transparency, accuracy, timeliness, ethical considerations, and potential impact on the company's financial health and stakeholder relationships. The chosen approach should be the one that best balances these factors, prioritizing clear communication and responsible financial management. Question 13. System analysis indicates a mortgage broker in the Australian Capital Territory Act is assisting a client with a home loan application. During the process, the broker discovers the client has a significant personal loan that was not initially disclosed. The client expresses concern about how this undisclosed debt might affect their borrowing capacity and asks the broker to proceed with the application without mentioning it, suggesting they will pay it off soon. What is the most appropriate course of action for the mortgage broker? Option A. Proceed with the application, omitting the undisclosed debt, and hope the lender does not discover it during their assessment. Option B. Downplay the significance of the undisclosed debt to the lender, suggesting it is a minor issue that will not impact the borrowing capacity. Option C. Advise the client that the undisclosed debt must be disclosed to the lender, and explain the implications of non-disclosure. If the client refuses to disclose, the broker must withdraw from the application. Option D. Advise the client to pay off the debt immediately and then submit the application, assuming the lender will not inquire about past financial obligations. The correct answer is C. Advise the client that the undisclosed debt must be disclosed to the lender and explain the implications of non-disclosure. If the client refuses to disclose, the broker must withdraw from the application. Explanation. Scenario analysis. This scenario presents a professional challenge for a mortgage broker in the Australian Capital Territory Act due to the inherent conflict between client advocacy and the lender's due diligence requirements. The broker must navigate the ethical imperative to act in the client's best interest, while also ensuring the accuracy and completeness of information provided to the lender, as misrepresentation can have serious legal and financial consequences for all parties involved. The pressure to secure a loan for a client, especially in a competitive market, can create a temptation to overlook or downplay potentially problematic information. Correct approach analysis. The best professional practice involves a transparent and thorough approach that prioritizes accurate disclosure. This means the mortgage broker should clearly explain to the client the implications of the undisclosed debt on their borrowing capacity and the mortgage application. They should then advise the client that the debt must be disclosed to the lender. If the client refuses, the broker must ethically withdraw from the application, as proceeding would involve facilitating a misrepresentation. This approach aligns with the principles of honesty, integrity, and client duty of care, as well as the regulatory obligations under the National Consumer Credit Protection Act 2009, CTH, NCCP Act, which mandates responsible lending and prohibits misleading or deceptive conduct. Incorrect approaches analysis. One incorrect approach involves proceeding with the application while omitting the undisclosed debt, hoping the lender will not discover it. This is a direct violation of the NCCP Act's responsible lending obligations and constitutes misleading conduct. It exposes the client to potential loan rejection, default, and severe financial hardship, and the broker to disciplinary action, fines, and reputational damage. Another incorrect approach is to advise the client to simply pay off the debt immediately without disclosing it to the lender, assuming this rectifies the situation. While paying off debt is generally positive, failing to disclose its prior existence and the circumstances surrounding it could still be considered misleading if the lender specifically asks about past financial obligations or if the broker omits this information from the application. The lender has a right to a complete financial picture. A third incorrect approach is to downplay the significance of the debt to the lender, suggesting it is a minor issue that won't affect borrowing capacity. This is a form of misrepresentation. The broker is not qualified to unilaterally determine the lender's assessment criteria or the impact of undisclosed debts. Such an action undermines the lender's risk assessment process and breaches the broker's duty to provide accurate information. Professional reasoning. Professionals in this situation should employ a decision-making framework that begins with identifying the core ethical and regulatory obligations. This involves understanding the client's needs and objectives, but critically, it also requires a commitment to honesty and transparency with all parties, especially the lender. When a conflict arises, such as a client's desire to withhold information, the professional must prioritize regulatory compliance and ethical conduct. This means clearly communicating the risks and consequences of non-disclosure to the client, advising on the correct course of action, full disclosure, and being prepared to cease engagement if the client insists on a course of action that would lead to a breach of law or ethical standards. Question 14. System analysis indicates a vendor in the Australian Capital Territory Act is seeking to sell their property and has asked their real estate agent to explain the differences between an exclusive right to sell, an exclusive agency, and an open listing agreement. The vendor expresses a desire to retain maximum control over the sale process and is concerned about incurring commission if they introduce a buyer themselves. What is the most ethically sound and professionally responsible course of action for the agent to advise the vendor? Option A. Recommend an exclusive agency agreement, clearly explaining that commission is only payable if the agent introduces the buyer, but the vendor can sell independently without owing commission. Option B. Urge the vendor to sign an exclusive right to sell agreement, highlighting the increased marketing efforts the agent will undertake, without fully clarifying the commission obligations if the vendor finds the buyer. Option C. Advise the vendor to sign an exclusive right to sell agreement, emphasizing the agent's guaranteed commission, and downplaying the vendor's ability to introduce a buyer without incurring fees. Option D. Suggest an open listing, without detailing the potential for disputes over commission entitlement if multiple agents are involved or if the vendor introduces a buyer. The correct answer is A. Recommend an exclusive agency agreement, clearly explaining that commission is only payable if the agent introduces the buyer, but the vendor can sell independently without owing commission. Explanation. This scenario presents a professional challenge for a real estate agent in the Australian Capital Territory Act. Due to the inherent conflict between securing a listing and upholding ethical obligations to the client, the agent must navigate the nuances of different listing agreements while ensuring transparency and acting in the client's best interest, as mandated by the ACT's property agent legislation and professional conduct standards. The core difficulty lies in balancing the desire for a guaranteed commission with the client's right to explore all avenues for selling their property. The correct approach involves clearly explaining the implications of each listing agreement type to the vendor, allowing them to make an informed decision based on their risk tolerance and desired level of control. Specifically, recommending an exclusive right to sell agreement, while potentially offering the agent the highest security of commission, must be presented with full disclosure of its implications. This means the vendor is obligated to pay the agent's commission regardless of who introduces the buyer, provided the sale occurs within the agreement period. The agent's ethical duty, reinforced by ACT regulations concerning disclosure and client representation, requires them to ensure the vendor fully understands this commitment and its potential financial consequences. Transparency about the agent's role and the vendor's obligations is paramount. An incorrect approach would be to pressure the vendor into signing an exclusive right to sell agreement without thoroughly explaining that they will owe commission even if they find the buyer themselves, or if the agent introduces a buyer who later withdraws. This misrepresentation or lack of full disclosure violates the agent's duty of care and honesty under ACT law, which requires agents to act with integrity and provide accurate information. Another incorrect approach is to agree to an open listing without clearly defining the terms and the agent's responsibilities. An open listing, while offering the vendor maximum flexibility, can lead to disputes if the agent expends significant effort without a clear understanding of their entitlement to commission, potentially contravening the spirit of fair dealing expected under ACT regulations. Furthermore, failing to document the chosen listing agreement clearly and comprehensively, or misrepresenting the exclusivity of an exclusive agency agreement, where commission is only paid if the agent introduces the buyer, but the vendor can sell independently without owing commission, would also constitute a breach of professional conduct and regulatory requirements. Professionals should approach such situations by prioritizing client education and informed consent. This involves a structured process of discussing the vendor's objectives, explaining the distinct characteristics, benefits, and drawbacks of each listing agreement type, exclusive right to sell, exclusive agency, and open listing, in plain language, and documenting the agreed-upon terms meticulously. The agent's role is to advise and facilitate, not to coerce, ensuring the client's decision aligns with their best interests and understanding. Question 15. The efficiency study reveals that a real estate agent in the Australian Capital Territory Act is representing a vendor in the sale of their property. The agent, after assessing the property's market value, develops a personal interest in purchasing the property themselves for investment purposes. What is the most ethically and legally sound course of action for the agent to take in this situation? Option A. Delegate the negotiation and sale process entirely to another agent within their agency, without informing the vendor of their personal interest in acquiring the property themselves. Option B. Proceed with the sale of the property to another buyer, while discreetly arranging to purchase the property from the new owner immediately after settlement, thereby avoiding direct conflict with the current vendor. Option C. Immediately disclose their personal interest in purchasing the property to the vendor in writing, detailing the nature and extent of their interest, and obtain the vendor's explicit written consent before proceeding with any further actions related to the sale or their potential purchase. Option D. Inform the vendor verbally about their interest in purchasing the property, but proceed with marketing and negotiating offers without obtaining written consent, assuming the vendor understands. The correct answer is C. Immediately disclose their personal interest in purchasing the property to the vendor in writing, detailing the nature and extent of their interest, and obtain the vendor's explicit written consent before proceeding with any further actions related to the sale or their potential purchase. Explanation. The efficiency study reveals a potential conflict of interest scenario for real estate agents in the Australian Capital Territory Act. This situation is professionally challenging because it requires agents to balance their fiduciary duty to their client with the potential for personal gain, which could compromise their objectivity and the client's best interests. Navigating this requires a deep understanding of the ACT's property services legislation and ethical codes. The correct approach involves full disclosure and obtaining informed consent. This means the agent must proactively inform the vendor of their personal interest in purchasing the property, detailing the nature and extent of that interest. They must then obtain the vendor's explicit, written consent to proceed with the transaction under these circumstances. This aligns with the principles of transparency and good faith mandated by the ACT Civil and Administrative Tribunal (ACAT) and the Property Occupations Act 2002, which require agents to act honestly and in the best interests of their clients. This approach prioritizes the client's autonomy and ensures they can make an informed decision, thereby upholding the agent's fiduciary obligations. An incorrect approach would be to proceed with the purchase without informing the vendor. This constitutes a serious breach of trust and fiduciary duty. It violates the agent's obligation to act in the client's best interests and undermines the principle of informed consent, potentially leading to accusations of misleading conduct and a breach of the agent's licensing obligations under ACT law. Another incorrect approach would be to inform the vendor verbally, but not obtain written consent. While disclosure is a step in the right direction, the absence of written confirmation means there is no verifiable record of the vendor's understanding and agreement. This leaves room for future disputes and does not meet the standard of clear, documented consent required to mitigate conflicts of interest effectively under ACT regulations. A further incorrect approach would be to delegate the negotiation to another agent within the agency without disclosing their personal interest to the vendor. While this might seem like a way to maintain objectivity, it still involves the principal agent benefiting from a transaction where their personal interest could influence decisions, even indirectly. The lack of full transparency with the vendor about the principal agent's direct involvement and personal stake is ethically problematic and potentially breaches disclosure requirements. Professionals should adopt a decision-making framework that prioritizes transparency and client welfare. When a potential conflict of interest arises, the first step is to identify it clearly. Then, consult relevant legislation and professional codes of conduct. The paramount consideration should always be the client's best interests. If a conflict cannot be effectively managed through full disclosure and informed consent, the agent should consider withdrawing from the transaction to avoid compromising their professional integrity and legal obligations. Question 16. Market research demonstrates that real estate investment trusts, REIT, are gaining traction in the Australian Capital Territory Act property market. An investment advisor is approached by a client seeking to diversify their portfolio with property exposure. Considering the regulatory framework governing financial products in Australia, which of the following approaches best aligns with professional and ethical obligations when advising on ACT-relevant rate? Option A. Advise the client to invest in rate primarily based on their potential tax advantages within the ACT, without a detailed analysis of the underlying property assets or management quality. Option B. Conduct a thorough assessment of the client's financial situation, risk tolerance, and investment objectives, and then recommend specific ACT-relevant rate that demonstrably align with these factors, providing clear and comprehensive disclosure of all associated risks, fees, and potential returns in compliance with the Corporations Act 2001, CTH. Option C. Suggest rates that are not yet widely regulated or have minimal disclosure requirements, arguing that this offers greater flexibility and potentially higher returns. Option D. Recommend rates that have shown strong historical performance in the ACT property market, focusing on their potential for capital appreciation and rental income, without extensive client-specific suitability checks. The correct answer is B. Conduct a thorough assessment of the client's financial situation, risk tolerance, and investment objectives, and then recommend specific ACT-relevant rate that demonstrably align with these factors, providing clear and comprehensive disclosure of all associated risks, fees, and potential returns in compliance with the Corporations Act 2001, CTH. Explanation. This scenario presents a professional challenge because it requires an investment advisor to navigate the specific regulatory landscape of the Australian Capital Territory Act concerning real estate investment trusts, REIT, while considering the client's risk tolerance and investment objectives. The advisor must ensure that any recommendation aligns with the Corporations Act 2001, CTH, and any relevant ACT-specific property investment guidelines, particularly concerning disclosure and suitability. The core difficulty lies in balancing the potential benefits of REIT as an investment vehicle with the need for full transparency and adherence to regulatory requirements. The best approach involves a comprehensive assessment of the client's financial situation, risk profile, and investment goals, followed by a detailed explanation of how specific ACT-relevant rate align with these factors. This includes clearly outlining the risks and potential returns associated with each rate, ensuring all disclosures are made in accordance with the Corporations Act 2001, CTH, and any applicable Australian Securities and Investments Commission, ASIC, guidance. This approach is correct because it prioritizes client best interests, adheres to the principles of responsible investment advice, and ensures compliance with Australian federal legislation governing financial products like rate. An incorrect approach would be to recommend a rate solely based on its historical performance, without adequately assessing its suitability for the client's specific circumstances, or without fully disclosing the associated risks. This fails to meet the advisor's fiduciary duty and breaches the Corporations Act 2001, CTH, by potentially providing misleading or incomplete information. Another incorrect approach is to focus only on the potential tax benefits of rate within the ACT without considering the underlying asset quality, management structure, or liquidity, thereby neglecting a holistic risk assessment and potentially exposing the client to undue risk. Recommending a rate without verifying its compliance with Australian regulatory disclosure requirements, such as those mandated by ASIC, is also professionally unacceptable, as it undermines investor protection. Professionals should employ a structured decision-making process that begins with understanding the client's needs and objectives. This is followed by thorough research into available investment products, including rate, with a specific focus on their regulatory compliance and suitability for the client. A critical step is transparent communication of all relevant information, including risks, fees, and potential returns, ensuring the client can make an informed decision. This process is underpinned by a commitment to acting in the client's best interests and adhering strictly to all applicable Australian laws and regulations. Question 17. Governance review demonstrates that a real estate agent in the Australian Capital Territory Act is preparing to enter into a buyer representation agreement with a prospective buyer. Which of the following actions best ensures compliance with ACT regulatory requirements and ethical professional conduct? Option A. Presenting the buyer representation agreement for signature at the first meeting with minimal explanation, assuming the buyer will read and understand it independently. Option B. Providing the prospective buyer with a written disclosure document detailing the terms of the buyer representation agreement, including the agent's duties, scope of representation, duration, and potential conflicts of interest, and explaining it thoroughly before seeking a signature. Option C. Providing the buyer representation agreement only after the prospective buyer has indicated a strong interest in a particular property. Option D. Verbally summarizing the main points of the buyer representation agreement to the prospective buyer during an initial meeting, without providing a written document. The correct answer is B. Providing the prospective buyer with a written disclosure document detailing the terms of the buyer representation agreement, including the agent's duties, scope of representation, duration, and potential conflicts of interest, and explaining it thoroughly before seeking a signature. Explanation. This scenario presents a professional challenge due to the critical importance of adhering to the specific disclosure requirements mandated by the ACT's property laws and professional conduct rules when engaging in buyer representation. Failure to provide accurate and complete information regarding the nature and implications of a buyer representation agreement can lead to significant legal repercussions, ethical breaches, and damage to the agent's reputation and the agency's standing. Careful judgment is required to ensure all parties fully understand their rights and obligations. The best professional practice involves providing the prospective buyer with a comprehensive disclosure document that clearly outlines the terms of the proposed buyer representation agreement, including the agent's duties, the scope of representation, the duration of the agreement, and any potential conflicts of interest. This document should be presented and explained to the buyer before they sign the agreement, allowing ample opportunity for questions and clarification. This approach is correct because it aligns with the principles of informed consent and transparency fundamental to ethical real estate practice in the ACT. Specifically, it upholds the spirit and letter of ACT legislation and professional standards that require agents to act honestly and in the best interests of their clients, ensuring clients can make well-informed decisions. An approach where the agent verbally summarizes the key terms of the buyer representation agreement without providing a written disclosure document is professionally unacceptable. This fails to create a clear, documented record of the information provided and leaves the buyer vulnerable to misunderstanding or misinterpreting the terms. It also creates a significant risk for the agent, as it becomes difficult to prove what was communicated. Another unacceptable approach is to present the buyer representation agreement for signature immediately upon the first meeting, with minimal explanation, assuming the buyer will read and understand it independently. This bypasses the agent's ethical obligation to ensure the client's understanding and can be seen as pressuring the client into an agreement without full comprehension. Finally, an approach where the agent only provides the buyer representation agreement after the buyer has expressed strong interest in a specific property is also professionally flawed. This delays crucial disclosure and may lead the buyer to feel obligated to sign the agreement to proceed with a property they desire, rather than making a fully informed decision about the representation itself. Professionals should adopt a decision-making framework that prioritizes client education and transparency. This involves proactively providing clear, written disclosures about all agreements, dedicating sufficient time to explain terms and answer questions, and ensuring clients have the opportunity to seek independent advice if they wish, all within the regulatory framework of the ACT. Question 18. Governance review demonstrates that a real estate agent in the Australian Capital Territory Act is advising a client on a potential investment property. The client is seeking a balance between immediate rental income and long-term capital growth, Which of the following analytical approaches best aligns with regulatory compliance and professional best practice in the ACT? Option A, emphasizing the property's current market value and potential for a quick resale, while minimizing discussion of any potential negative impacts from upcoming ACT planning changes or local economic downturns. Option B, focusing primarily on the projected rental income, highlighting the immediate cash flow benefits to the client without extensively detailing long-term capital appreciation prospects. Option C, prioritizing the agent's commission by recommending the property that offers the highest immediate return for the agent, irrespective of a comprehensive analysis of the client's long-term investment goals. Option D, conducting a thorough due diligence process that includes analyzing the property's potential for capital growth and rental yield, benchmarking against comparable ACT properties and market trends, and clearly articulating all associated risks to the client. The correct answer is D, conducting a thorough due diligence process that includes analyzing the property's potential for capital growth and rental yield, benchmarking against comparable ACT properties and market trends, and clearly articulating all associated risks to the client. Explanation: this scenario is professionally challenging because it requires balancing the client's immediate financial goals with the long-term implications of investment decisions, all within the specific regulatory framework of the Australian Capital Territory Act. The agent must act in the client's best interest while adhering to the Property Occupations Act 2002 Act and its associated regulations, which govern the conduct of real estate agents. The core challenge lies in providing advice that is both commercially astute and ethically sound, avoiding any misrepresentation or misleading conduct. The best approach involves a comprehensive analysis that considers the property's potential for capital growth and rental yield, benchmarked against comparable ACT properties and broader market trends. This includes a thorough due diligence process, examining factors such as zoning, development potential, local infrastructure, and any upcoming ACT government planning initiatives that could impact property values. The agent should also clearly articulate the risks associated with the investment, including market volatility, interest rate fluctuations, and potential vacancy periods, and ensure the client fully understands these before committing. This aligns with the agent's duty of care and the ethical obligation to provide informed advice under ACT real estate law, ensuring the client makes a decision based on a realistic assessment of both opportunities and risks. An approach that focuses solely on the immediate rental income, without considering the property's long-term capital appreciation potential, is insufficient. This fails to provide a holistic view of the investment's performance and could lead to a suboptimal outcome for the client, potentially breaching the duty to act in the client's best interests by overlooking significant growth opportunities. Another unacceptable approach is to downplay or omit discussion of potential risks, such as upcoming changes to ACT planning laws or the possibility of increased vacancy rates due to local economic shifts. This constitutes misleading conduct and a failure to disclose material information, which is a direct contravention of the Property Occupations Act 2002 Act, and undermines the client's ability to make an informed decision. Furthermore, an approach that prioritizes securing a quick sale to earn commission over providing thorough, objective advice is unethical and illegal. Agents have a fiduciary duty to their clients, which supersedes their own financial interests. Failing to conduct adequate due diligence or present a balanced view of the investment's prospects would be a serious breach of this duty. Professionals should adopt a decision-making process that begins with a clear understanding of the client's objectives and risk tolerance. This should be followed by rigorous research and analysis, adhering strictly to the regulatory requirements of the ACT. Transparency and open communication with the client, including a clear articulation of both potential benefits and risks, are paramount. The agent must always act with integrity and competence, ensuring all advice is objective, well-supported, and compliant with ACT legislation. Question 19. Governance review demonstrates that a property transaction in the Australian Capital Territory Act involves a purchase price of $750,000. The ACT Revenue Office has confirmed the market value of the property is also $750,000, based on the progressive stamp duty rates for non-residential properties in the ACT. What is the total stamp duty payable? Option A $30,000. Option B $42,200, option C $37,500, option D $45,000. The correct answer is B $42,200. Explanation: this scenario presents a professional challenge due to the need to accurately calculate and apply stamp duty, a significant financial obligation for property transactions in the Australian Capital Territory Act. Miscalculation can lead to underpayment, resulting in penalties and interest, or overpayment, causing financial hardship for the buyer. The complexity arises from the tiered tax rates and potential exemptions, requiring meticulous attention to detail and a thorough understanding of the relevant ACT legislation. The correct approach involves a precise calculation of the stamp duty based on the dutiable value of the property and the applicable rates under the ACT's Duties Act 1999. This requires identifying the correct dutiable value, which is typically the market value or the consideration paid, whichever is greater. Then, the appropriate tax rate for the relevant bracket must be applied. For instance, if the dutiable value is $750,000, the calculation would be: first $22,500 at 5% $0 0.15 times $22,500 equals $337. 50 next $22,500 up to $45,000 at 5% $0 0.35 times $22,500 equals $787. 50 next $45,000 up to $90,000 at 5% $0 0.45 times $45,000 equals $2,025 00 next $110,000 up to $200,000 at 5% $0 0.55 times $110,000 equals $6,050 00 the remaining amount $750,000 $200 000 equals $550,000 at 6% $0 0.6 times $550,000 equals $33,000 total stamp duty equals $337. 50 plus $787. 50 plus $2 0.25 00 plus $6 0.50 00 plus $33 000 equals $42,200 00. This method ensures compliance with Section 10 of the Duties Act 1999 Act, which defines dutiable value, and the subsequent tax rate schedules outlined in the Act. An incorrect approach would be to use a simplified flat rate for stamp duty, such as applying a single percentage to the entire property value without considering the progressive tax brackets. This fails to adhere to the tiered rate structure mandated by the Duties Act 1999 Act, and would likely result in an incorrect calculation, potentially leading to penalties. Another incorrect approach would be to only consider the purchase price and ignore the possibility that the market value might be higher, as Section 10 of the Duties Act 1999 Act specifies that the dutiable value is the greater of the consideration or market value. Failing to account for potential concessions or exemptions, such as those for first home buyers, without verifying eligibility according to the relevant provisions of the Duties Act 1999 Act, would also be an error. The professional decision-making process for similar situations should begin with a thorough review of the property transaction details, including the contract of sale and any supporting documentation. It is crucial to consult the most current version of the ACT's Duties Act 1999 and any relevant revenue circulars or guidelines issued by the ACT Revenue Office. A step-by-step calculation, applying the correct dutiable value and the progressive tax rates, is essential. If there is any doubt regarding eligibility for concessions or the interpretation of specific clauses, seeking clarification from the ACT Revenue Office or consulting with a legal professional specializing in ACT property law is advisable.